Hello and welcome to your Daily Five. I'm Greg Harmon, founder and president of Dragonfly Capital Management. At Dragonfly Capital Management, we provide technical analysis to create trade ideas that the do-it-yourselfer can use themselves to manage their own portfolio, as well as run separately managed accounts for clients that have high net worth assets that don't have the time to do it themselves. Today, I want to spend a little time talking about something that I hear a lot of. Are we in a bear market rally? How many times have you heard, this is just a bear market rally? Since the March lows, the March 20 lows, the markets have risen substantially. Now we're 2 months into this, yet we still hear every day about bear market rallies. To the purist, a bear market is going to continue until we get a new high in the S&P 500, or for those Dow theorists, in the Dow Jones Industrial Average, and then confirmed by the Dow Transports. But are we really still in a bear market rally? And does it really matter? So let's take a look at 5 charts that I've picked out to kind of talk a little bit about this and present maybe a different opinion about whether or not this is just a bear market rally. The first one I've put here is the S&P 500, shown by the ETF, the SPY Spider. And you'll notice that I use the unadjusted price. I'm looking at just pure price movement on this, so it's not smooth for dividends. And what do we see here? From the March 23 low, the Spider has retraced over 61% of its drop from the February highs. 61.8%. For you Fibonacci traders, the key retracement level gets you into an area where we have to start talking about real positive events going on. And you can see the struggle between the 50% level and the 61.8% level that occurred for over a month. And now finally starting to put a little space above that 61.8% level. But there's also some interesting aspects just above. We see that this chart that's as of the close on yesterday ended right at the 100-day moving average. And just above that, right around the 300 level, is the 200-day moving average. So the SPY, even though it has retraced over 61.8% of its drop, is still below its 200-day moving average. One of the most basic aspects of technical analysis. Markets are positive, markets are investable when stocks and indexes are trading above their 200-day moving average. So despite having retraced 61.8% of this path, still below the 200-day moving average, this is, I think, what gets us into this discussion all the time about whether or not we're still in a bear market, whether or not this market is investable or not. And the result of that has been this flatlining of momentum. You see the RSI going flat up here for the last month and a half, and you see the MACD also going flat, but positive. So let's take a look at some other indexes that maybe will give us a hint as to whether or not we can view this from a different perspective. The first one is the Dow Jones Industrial Average. And you see the Dow Jones Industrial Average has not been as strong, has been oscillating around the 50% retracement level, has not reached the 61.8% level. What's more, you see that the 100-day and 200-day moving averages, much further above, are both starting to roll negative. They're both starting to roll lower. So despite momentum being flat, the Dow Jones Industrial Average looks a whole lot less interesting as an investable index than the S&P 500 does at this point. Why is that? Let's look at the contrast to that. And that would be the NASDAQ 100, shown here using the triple Qs. And quite impressive movement here. The triple Qs broke over the 88.6% retracement level to close above that yesterday. They also filled their gap from February. This, if you were looking at it in isolation, would tell you that the stock market is ready. It's time to put all your money in. Momentum is picking up again. We've got RSI very much in the bullish zone. We've got a very positive MACD. We're above both the 200 and 100-day moving averages. And there's nothing here that doesn't say uptrend in the NASDAQ 100. So how do we reconcile the differences between the NASDAQ 100, the Dow Jones Industrial Average, and the S&P 500? One thought is that maybe with this pandemic, as we saw following the great financial crisis as well, there's been huge shifts in where capital sees the future of the economy. Shifts away from strong industrial companies into more technologically based companies that will be the wave of the future. How do we notice this? Let me give you the final two charts. The first one is the iShares software ETF. The iShares software ETF here has now retraced over 93% of its drop. Software as a service has become the leading industry in terms of driving growth, or a leading industry. And you can see strong momentum here as well. And then my final chart, the biotech ETF, the iShares biotech ETF, which has not only retraced its drop from the February 2020 highs to the low, but has gone on to exceed it and excel to 138.2% of that drop. Not at its all-time highs, it's getting very close to its all-time highs from 2016. But this sector has truly been a leader. So is it possible that we're not in a bear market anymore, but rather a bull market where the leadership has vastly changed to being driven by more technologically based companies? That's my Daily 5. Thanks for watching.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.